the interview, the world's largest active bond fund manager is preparing for the possibility of a global recession if inflation in the U.S. and Europe isn't managed properly by the central banks. Daniel Iveson, chief investment officer at PIMCO, said they're leaving room for a harder landing, not a soft one. That might be because this past week, leaders of central banks publicly told us their position that interest rate hikes are still in our future. So let's see what economist Dr. Michael Greiner has to say about it. Another thing I worry about is the coordination between central banks. I mean, you're talking about the Fed, you're talking about the European Central Bank, Bank of England, et cetera. And depending on what they do, if they're moving not in tandem, that can be not necessarily catastrophic, but it won't have the effect on rates that we're looking for, because this is a global economy. And as isolationist as some may wish, that's just not the reality of this. And so how much coordination do you think there needs to be able to slow inflation across the world?
Well, I mean, it's funny you say that, because there was recently a meeting of the leaders of a number of the major central banks, and they kind of emphasized the fact that they're all on the same page in terms of dealing with inflation.
They don't always act on the same page, but
no, they don't, for sure. And China, for all intents and purposes, is right now in a severe recession, and so there's actually talk about them trying to reduce interest rates to try to gin up their economy a little bit. You're right about the fact that they're not on the same page, but I mean, part of it is that they're dealing with, even though it is a global economy, they're dealing with different circumstances here. Like, for example, in the UK, where they're dealing with the whole Brexit issue, their economy has really been struggling. They've had much higher inflation than you've had on the continent, much higher inflation than you've had in the United States. Germany, I believe, right now is actually technically going into recession. So, you know, you've got these different factors at play where the different central banks are trying to deal with their own individual factors. And they're, in some respects, a lot of them are looking at the United States with jealousy over the fact that we do have these strong figures coming out one time after another after another.
Iveson did also say that people are way too confident about the ability of central banks generally to cut policy rates as quickly as the yield curves are implying. Is that right? Wrong?
No, that's certainly true. And as I say, I think that if you ask Chairman Powell candidly that, he would agree with that. You know, he's very frustrated with the fact that, for example, as they've been increasing interest rates because of the way that the mortgage market is right now, mortgage rates have been quite a bit lower than they'd like to see, actually. So that has meant that you've seen a surprising resilience in the construction market, in the real estate market, much more so than I think that the Fed was anticipating when it was first raising these interest rates.
When you look at Wall Street, the numbers are outrageous. I mean, the NASDAQ was just going gangbusters. It had its best first half of the year in like 4 decades. You know, if you were invested in Apple stock, you were probably very happy because of the tremendous market cap, becoming the most valuable company in the world, you know, $3 trillion. If all of these central banks are committed to the idea of continuing to raise interest rates and get inflation under control, but you have a job market that's strong and you have a stock market that's strong, something is not happening correctly.
Right. It's not like the Fed is able to just kind of wave a magic wand and all of a sudden the interest rates are set. You know, they actually essentially operate on the interest rates through the banking system, where they will essentially require higher essentially cash reserves for I'm oversimplifying here, but they'll require higher cash reserves for the different banks, which then means that they have less money to lend out, which then, of course, drives up interest rates. So when you talk about it in that way, you can see where they are dealing with an imperfect mechanism here. You know, they're trying to manage the overall economy, which is very difficult to manage, but they can't even set the interest rates.
We kind of saw that mini run on banks already. So if we end up with something like, you know, a wide downgrading of, say, company credit ratings, et cetera, and there's like a sell-off of collateralized loan obligations, how could that impact the economy generally, and what would you expect to happen there?
Well, I mean, that would be a big problem. But the good news is that I just saw information about the stress tests of the major banks. And actually, they're much better funded than they had been in the past. In fact, there's a push right now by some of the banks to try to move toward either increasing their dividends or buying back some stock because they're so well funded at this point.
And for everyone talking about a possible pivot, Powell said this week, even though interest rate hikes have been persistent and steep, he added policy hasn't been restrictive enough for long enough.